Hello and welcome. I'm Blair Blackwell, and this is the Daily Market Brief. Let's catch up on what's moving in markets today.
Good morning. It's Thursday, February 26th, and this is your New York Open Prep. The big themes: steady central banks facing stickier growth in places like the UK and Euro area, a mixed risk tone after tech and crypto selling, and commodities watching geopolitics with oil in focus. On policy, the Federal Reserve narrative remains steady, with TD Securities arguing a firm U.S. labor backdrop and contained inflation point to cuts later rather than sooner. In the UK, stronger early-year activity is raising questions about how quickly the Bank of England can ease, even as next week's spring statement is expected to be a low-key fiscal update. Over in Europe, the European Central Bank's Christine Lagarde says artificial intelligence is lifting productivity without triggering broad layoffs yet, and a new Eurozone financial impulse gauge from Commerzbank points to conditions consistent with solid growth. Japan remains a swing factor for currencies, with the yen firmer after hawkish-sounding remarks around the Bank of Japan pressured GBP-JPY. That said, some houses still warn normalization could lag under more dovish-leaning nominees. A reminder the yen's path may be bumpy. Meanwhile, in India, Commerzbank sees the central bank holding rates with inflation contained and growth firm. Turning to markets, tech and crypto have been under pressure, but Fundstrat's Tom Lee suggests the shakeout may be nearing its end. In autos, Stellantis reported its first annual loss as it wrote down electric vehicle investments and reset strategy, underscoring a more selective phase for the EV rollout. U.S. CEOs, for their part, don't plan to add many jobs this year, reinforcing a low-hire, low-fire labor rhythm that keeps wage growth and turnover moderated. Commodities are tied to geopolitics, with nuclear talks in Geneva coinciding with Iranian crude floating at record levels, which could weigh on prices if barrels reach market. One major bank even sees oil drifting toward the low 60s by year-end if tensions ease. Angola's Sonangol is looking beyond oil into critical minerals, another sign of the shifting energy and materials landscape. Gold remains well-owned as a safe haven, while in FX, we've seen USD dollar CHF bounce on a modest dollar recovery, alongside broader haven demand. For markets and sectors, that mix is modestly supportive for the dollar, against growth-sensitive currencies like the Aussie, where BNY flags scope for rebalancing. Euro sentiment is steadier on improving financial conditions, while UK data resilience tilts sterling slightly firmer against peers with looser policy paths. Oil is headline-driven, and gold's bid endures on risk wobble. Looking ahead, the immediate calendar is quiet. Focus stays on policy signaling, any updates around nuclear talks, and corporate guidance, with the UK's spring statement on March 3rd. What you should be watching today: the Aussie dollar against the US dollar, looking for a softer bias if risk appetite fades and dollar rebalancing kicks in. Sterling versus the dollar, a firmer tone if markets lean toward a slower Bank of England easing path. Sterling against the yen, a downside bias if hawkish BOJ chatter sustains yen gains. Dollar franc, two-way trade, but watch for upside flicks if safe haven demand is expressed via the dollar. Dollar loonie, a drift lower if Canada's improved external balance and any oil stabilization support the Canadian dollar. And in commodities, keep an eye on Brent, with downside risk if talks progress and floating supply grows, and gold for continued defensive interest. In short, policy is steady, growth pockets are holding up, and risk sentiment is cautious but trying to base. Markets are optimistic, just selectively so.
That's it for today's edition of the Daily Market Brief. Thanks for listening. I'm Blair Blackwell. This podcast is for informational purposes only and does not constitute financial advice, trading recommendations, or investment guidance.